Good morning, everyone. Welcome to another session on the subject corporate and economic laws. Day before yesterday, I had covered two aspects under this particular subject, that is SEBI Act and LODR. And today, again under the economic laws, we are going to cover another important topic, that is the SARFAESI Act. As we all know that this is part of the allied laws and economic laws under this particular subject, and very important, friends, though these acts are small but quite relevant, as I said in my previous class also, in terms of professional life as well as in terms of exams. So today in next 3 hours I'll be trying to cover all the basic concepts along with the provisions, and I'll be taking some MCQs and relevant practical questions which have been asked in the exams. So let us all start, and I hope you are ready with your pen and paper or copy to write down the important notes. Wherever I mention these are important things, so please do take a note of the same. And obviously I think the institute is going to share the presentation also in due course of time, so that you can relate to what I am speaking and then mark the important points. Friends, I'm your friend, mentor, whatever you may call me, C. Naveen Khandelwal, taking you to this ride of SARFAESI Act. So let me start sharing the presentation. So friends, this is the name of the act, though the act name looks very big. It starts with the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest. But if you really break the act, then you will find that there are three angles. Friends, remember, there are three angles covered under this act. And the three angles are, if you see the whole act name, first name is securitization, that is the first part. Then the second part is the reconstruction. Now, reconstruction of what? The reconstruction of financial asset. And the third part is enforcement of security interest. So there are three angles for this particular act: securitization, reconstruction of financial asset, and enforcement of security interest. That is why in short it is termed as SARFAESI. SARFAESI, SA for securitization, RFA for reconstruction of financial asset, and ESI, the last part, SARFAESI last part, is enforcement of security interest. So that is how this whole act was named, because of the three processes involved in this particular act. So when this, why this act was required, and what is the end result once you go through this particular act. So the end result will be, obviously we will understand all the provisions of the SARFAESI Act, and then you will understand the whole regulation of this SARFAESI Act and the interest of the banks, and how the interest of the banks and financial institutions are secured. So to give you a background, friends, this act came into existence in 2002. The reason why it came into existence, again a long story, why the act was introduced, because it was observed that the lenders, that is the banks and the institutions, faced a lot of difficulties in recovering the amount from the borrowers in the event of default by the borrowers, because the process was long drawn, and it was subject to a lot of intervention of the court and various judicial authorities, and therefore the bank could not recover the amount in time, which actually led to a lot of litigation, the fall in the value of the assets, and therefore the bank was suffering in terms of increasing defaults, NPAs, and less liquidity. NPAs increasing, liquidity going down. So to create this balance of NPA coming down, increasing the liquidity, this SARFAESI Act was introduced, which gave the bank and the financial institution something additional, more power to you, more power to the bank under this SARFAESI Act. Applicability, it applies to whole of India, and we know that there are some acts which applies to whole of India except Jammu Kashmir, but now it is applicable to the whole of India, and normally applicable when the lender is bank and the financial institution. If you see, when you consider the act, as I mentioned in my previous lecture, you have to look at from the holistic point of view. Always look at the act from the holistic point of view. What is the macro impact, why it was introduced, and who are the stakeholders? Very important. The stakeholders should be very clear, because when you are reading the picture, when you're reading the act, the picture of the act should be clear. Who are the actors? Who are the villains? And obviously, there will be heroines also, not to forget them, but there'll be some masala, some songs. So here also, let us break down the whole act into different structure. And we have 6 chapters and around 42 sections. But the good part is that the course has been limited to only section 19, from 1 to 19. So that means the rest of the sections are not applicable to us in terms of exams. So that is the best part, and the act is very crisp and short, and therefore I would always suggest that you should concentrate on this particular act, because first, it is small, and second, what I have observed that one question is actually asked from this particular act, minimum of 4 to 8 marks. It ranges depending upon the type of question. So a high probability of scoring around the 6 marks on an average out of 100, which actually boosts up your confidence when you appear in those 3 hours in the exam. So the chapter 1 is very preliminary, which consists of the preamble and the definition part. And as I said, the act is divided into 3 parts. The securitization process, so from 3 to 12, the process of securitization and reconstruction has been given. Securitization and reconstruction from section 3 to 12. And then the enforcement of security interests from 13 to 19. 13 to 19, friends. So chapter 1, 2, 3 applicable to the exam part, and chapter number 4 to 6 not relevant. But yes, chapter number 4 is important in terms of having an understanding, friends. If you're doing your articleship, and if you're doing some concurrent audit of banks, then you must be aware of this word, central registry. In short, it is referred to as SARFAESI. I hope some of you, if you are doing concurrent audit or if you have done bank audit, probably you must be able to relate this word SARFAESI, that is a central registry, which has been created by the government to facilitate accumulation of information. It is a registry. Registry means where information is accumulated from all the sources, and anybody who wants to access, especially the banks, they can access it and see. So SARFAESI basically has the information about all the properties which has been mortgaged to bank, against which the bank has given a loan to any borrower across India. Okay, friends. So remember, so if any bank has given a loan, it will register that particular land in that SARFAESI. And if the other bank, if the borrower approaches that other bank with that same property, the bank can actually see whether the property has already been mortgaged or not. So the purpose is to safeguard the bank interest, to ensure there is no frauds happening in terms of taking a loan against the same property from different banks. So that is the concept of SARFAESI. So I have explained, because that will be used in the section 3 to 19 at different point of time. So that is why I thought it is better to explain this concept of central registry. Important concepts, friends. Once you go through this particular act, what are the important concepts? I think there'll be a lot of new terms which will be coming in front of you. There'll be new launch of an actor and actress. It depends upon you, how do you look at them. So we will understand certain concepts like central registry, which I explained just now. Some concepts like qualified buyers, security receipts, ARC trust, SPV. I think that's a common phenomenon which you must have learned somewhere else also. then mortgage-backed securities. So these are some, security interest. These are some important terms, and we always feel as a student, I always believe, even as a professional today, if I come across a new term which relates to our profession, that all really excites us, because we are always curious to know something new that actually happens in our daily life. So something new which is related to your profession, it comes in front of you. At least at initial point, you should be interested. Yes, what is it all about? That is why I regard SARFAESI Act as an interesting one, because there are a lot of new things. So as a general professional, you should be knowing all these new things, and later on you can obviously decide whether we want to go into this particular world or not. So first, before going into this act, let me go through the process. Once we understand the whole process of the bank, how the bank gives loan, and what are the terms which are created when the loan process goes on, and where does this SARFAESI Acts come into picture? See, in my previous class, when I gave you the structure of SEBI, I told you there are the stakeholders involved, the issuers, the intermediaries, the investors, and that is why the SEBI Act revolved around this whole process. So here also, if you understand the whole process and the terms involved, then I think again the story would be very clear. Obviously, things would unfold as we go on, but at least you have a trailer, teaser for the whole story. Friends, the process is, if you see the concept, as I told you, there are banks involved, the borrowers, the lenders. So first, let us understand where does this thing originate, whether the whole process originates. So the whole process originates from the bank angle. So therefore, the bank is known as originator. Originator. And what does the bank originates? The bank originates financial assistance. Financial assistance. And what is a financial assistance? In simple words, it is a loan. But then it has been defined under the head financial assistance, right? Because a loan may comprise of A, B, C, D things. So that is why financial assistance word has been given. So the originator, that is the bank, from where the financial assistance originates, and it is given to the borrower. And the borrower may be a company, an individual, a partnership firm, LLP. It can be anyone, right? So it is not restricted only to the companies. So borrower is, as general, anybody. And what does the borrower gives in to the originator, to the bank, when he takes a loan? Obviously, he has to provide certain kind of security. So that is the word security. And that security can be in the form of what? A movable property and an immovable property also. So movable property or immovable property. It can be anything. So security can be in the form of movable property like stock, immovable property like land, building, plant and machinery. It can be anything. So there is a security provided by the borrower. Now, can you tell me, there are certain additional words which are also created. So there is a mortgager, and mortgagee. So here the borrower is the mortgager and the bank is the mortgagee. So these are additional terms, because these are always confusing when you go for a bank audit and you observe all these words coming in: mortgager, mortgagee, transferor, transferee, security, property, pledge, hypothecation. So at times you tend to get confused. So I think this picture will give you more clearer demarcation of the words and to whom it applies. That is important, friends. We need to understand that. So we have the mortgager, we have the mortgagee. Obviously, if the mortgager is the borrower, then the mortgagee would be bank, right, who takes the property as a security. So what happens, friends, if this is the whole process which goes on, in due course of time, what can happen? What can happen is that this particular financial assistance which the bank has given to the borrower, that may turn out to be. See, normally when the bank is giving a loan, that loan is performing asset, PA, till the time the borrower is repaying the term loan, interest and everything. But it may happen because of multiple reasons, which we all understand. The PA can get converted into NPA, that is non-performing asset. Now what happens here? That when the loan is converted into NPA, and what is an NPA? We all understand, you must have gone through in the subject of audit. Under the bank audit, we know what is an NPA. There are the classification norms given by RBI, which the banks have to follow and the financial institutions have to follow. And based on that classification norms, the loans are classified as non-performing asset, as substandard, loss, and various other nomenclature are given. So when the performing assets gets converted into NPA, what is the problem? The problem here comes in that bank does not gets money from the borrower. It is not able to receive money from the borrower. So let's say, for example, if you are not able to receive your income, remember, whatever the borrower pays is an income for the bank. One more thing, just for the sake of again understanding, remember there will be two words. One second. Financial asset oblique debt. Now, financial asset for a bank, remember, for a bank, in their balance sheet, please mark my words, in their balance sheet, the loan which is given by bank is financial asset, right? But for a borrower, it is a debt. So remember, when we will be going through the various provisions under the SARFAESI, the words would be used as financial asset oblique debt. So don't get confused, because both are the same thing, only difference is in the perspective. Financial asset is being looked from the perspective of the bank, and debt is being considered on the part of the borrower. Correct? So I was talking about the situation where the performing assets gets converted into non-performing asset. That means the bank is not able to earn income. So if you are not able to earn income, how will you run? How will you manage? So that means the bank is facing some kind of liquidity problem. Mark my words, liquidity problem. As it happened with a lot of people during this particular COVID period, because there was no inflow of money and there was short of liquidity. That is why the RBI and the government took necessary steps to provide moratorium to all the businesses and told them that you should not, no installment should be paid during this particular period. Okay, so when the bank is not receiving money, it is having a liquidity problem. How will it do its business? How will it give more loans? So either it has to raise more funds, or new concept came in under the SARFAESI Act that the banks can sell these NPA account, sell these non-performing asset account to somebody. to somebody. Now the question comes in, why doesn't the bank makes an effort for recovery? Yes, the bank will surely make an effort for recovery from the borrower part. It will make all the efforts. But the bank primarily says that, my job is not for the recovery. My major job is not for recovery. Obviously, it is part of my business. I will make an effort for making the recovery part. But then sometimes it loses focus. And therefore, the option of came to the bank that if you want to sell all these bad loans, remember, what can you sell? Can you sell your liability or asset? We can sell our asset. And is that loan an asset for the bank? I mentioned the word financial asset. Remember, financial asset. So it is an asset for the bank. Therefore, that asset could be sold. Sold to whom? Who would be interested in buying these loans? Bad loans, that too a bad loan. So there are people in this world who are interested in buying those bad loans. Why would they be interested? The question obviously comes. Obviously, see, if anybody is trying to buy out, it must have its own criteria, reason, and they must have a business model, developed around this particular concept of buying out all the bad loans, and then they can earn money out of that. So here comes in the role of the asset reconstruction company, where these companies buy bad loans from the bank. They buy bad loans from the bank. And when you buy something, you have to pay. So they pay an amount to the bank. They pay an amount to the bank. So now you understand that when you receive money out of your bad loans, bank gets money, liquidity, which it requires for doing further business, So the asset reconstruction company, who is an asset reconstruction company, who will regulate that? That is what we will understand. So what I am trying to explain is the whole process of how SARFAESI will come into the picture. So asset reconstruction company will have to get registered under the SARFAESI Act. What process they have to follow to buy out the bad loans, that will be given in the SARFAESI Act. What will happen to the security which has been provided by the borrower to the bank, that is given under the SARFAESI Act. That is why this act came into existence, to facilitate the process of providing liquidity to banks against illiquid asset. Sir, what is a liquid asset? Friends, illiquid assets are NPA accounts. You got my point? Illiquid assets are NPA accounts. So bank is getting liquidity against illiquid assets. So the question comes in, what is ARC going to get the benefit? The ARC may buy out the bad loan at some discount price. See, if something is bad, you will get a discount on that. That is very natural. That's that's a business, phenomena. So let's say if the outstanding loan from the borrower in the books of accounts of the bank is, let's say, 10 crore, then the asset reconstruction company would pay, let's say, 6 crore to the bank to buy out that NPA account. Very natural. Nobody would object to it because it is a bad loan. Then what will the asset reconstruction company get if they buy out that bad loan of 6 crore? So they have a right to recover 10 crore. Remember, they have a right to recover 10 crore. From whom? From the borrower. From the borrower. You would say, sir, when the borrower is not able to pay to the bank, why would the borrower pay to the asset reconstruction company? So that is the capability of asset reconstruction company to reconstruct the financial asset. That is why in our Act SARFAESI, RFA, Reconstruction of financial asset. And what is a financial asset? As I mentioned to you friends, financial asset is the loan given to the borrower. So the asset reconstruction company is an expert who would try to reconstruct that financial asset and try to recover the amount, run the business, and whatever process has been given under the SARFAESI Act. And they will try to, recover the amount of 10 crore from the borrower. So the gain to the asset reconstruction company would be the difference in the buying out price and the recovery amount. That is one way. Now, the question would come, sir, what happens to the security? Who will keep the security? See, if the asset reconstruction company has taken the loan, obviously it will take the security also. So if you have taken the financial asset, so anything which is behind that financial asset will be handed over to the asset reconstruction company. That means the security will be transferred to the asset reconstruction company. So to that extent, the asset reconstruction company is secured to the value of the security, right? So that is why the asset reconstruction company takes the bad loan, because it knows that it has got certain kind of asset as a security behind them. Good. Now what next? The next question comes in, who will give money to the ARC to buy out those bad loans? So friends, here comes the concept of qualified buyers. So there are people in this market who would give money to the asset reconstruction company. And they will give cash, and in turn they will receive security receipt, SR in short. Now what is a security receipt, friends? Security. Remember, this is the security receipt. A receipt which will confirm them that this is against a particular security, that is mortgage-backed securities. This is SR, but what? Mortgage-backed securities. So this is a security receipt issued by asset reconstruction company, confirming them that yes, it's like a debt instrument in the form of any debenture, bond, whatever, giving them the interest to the qualified buyers, and as a security it is providing the asset which was originally given by the borrower to the bank. That is why they are termed as mortgage-backed securities, or in general, in terms of a document, it is known as security receipt. So friends, this is the whole scenario of the process under the SARFAESI. This is a process under the SARFAESI, and when you follow the process, you have to follow the guidelines as per the SARFAESI Act. So just trying to recall, friends, who are the people involved? The originator, bank, financial institution. Then financial asset. Remember the word financial asset. Remember the word mortgagee. Then the security word. Then obviously the concept of performing asset and non-performing asset. And the role of an intermediary which comes in ARC. Now here, see, remember, ARC is an intermediary between whom? The qualified buyers and the banks. Because ARC is just trying to raise money, give it to the banks. And obviously, in between, the ARC has a very important role of managing the borrower, reconstructing the borrower, trying to restructure his whole business in the process defined. So, a very important process designed under the SARFAESI Act, because of the SARFAESI Act, in this whole market of banking to provide funds. And let me tell you, friends, it's not a small market. It's not a small market. The market is huge, big, because the amount involved is big. It's not about 1 crore, 2 crores, 10 crores, 20 crores, 100 crores. The amount involved ranges from 100, 200, 300, 500 crore deals being done by asset reconstruction company with the banks. And in the current scenario, even in last 15, 20 years, you have seen the quantum of NPA increasing in the banking sector. And therefore, the role of ARC is becoming very important from, very important in terms of providing a balance or stability to this whole liquidity market in the banking world. To further take a deep dive in this whole process, I'll go one step further to explain more such terms. Now, you would ask me, sir, where is the word of securitization? Where is the word of securitization? See, friends, securitization is this process where the bank is able to raise money, liquidity through illiquid process by securitization of the security given by the borrower to the ARC and raising money against that. That is the securitization. Now, this particular process is more related to the non-performing asset. It could be possible for performing asset also. Securitization is a common term which can be applied to a normal performing asset also. I'll not take that into consideration because that is again another scenario. Because here we are more focusing on the debt which is under default. Now, this whole process of ARC will be working through a SPV. Remember, as a ARC, they are the asset managers. Now, in my structure, when I explained ARCs are in the form of trusts and through specific schemes. Now, what are specific schemes? So there could be specific ARC which are, let's say, related to power sector, real estate. So this could be specific ARCs which are created, and they will do the financial transaction, and they will assign the job of reconstruction to ARC, which is another ARC, not another ARC, but a part of this whole structure, which is purely working as an asset manager. So we have a trust which will do the financial transaction. We have the ARC as the asset manager who specializes in the management of the borrower. So remember, friends, this trust is, let's say, a SPV, special purpose vehicle, which is created for a particular bank, for a group of bank, for a particular sector of loan, for a particular industry. It can happen in any form. So it's a special purpose vehicle created for a specific purpose. While ARC as an asset manager is a general manager who will manage any borrower who will come into their business portfolio. But there are ARC who are expertise in specific sector also. So there are ARC specializing in power sector, something like that. So the business spectrum is wide, friends. And when you actually Google out, you will find there are so many ARCs. I think all banks also have their ARC divisions at times. Then all the big financial powerhouses, Edelweiss, they have a good big ARC structure. Phoenix ARC. You Google it out and you'll find a list of all the ARCs working in this world. So remember, friends, going back to my original transaction, the securitization process, reconstruction of financial asset, and the third part, enforcement of security interest. Where will that come into picture? Obviously, when the bank has sold their loan, fine, the bank is free. because they do not have that loan in their books of accounts. And then we have the asset reconstruction company. So now, if the asset reconstruction company is not able to recover the loan, or let's say if the bank has not sold the loan to asset reconstruction company, if they want to recover their loan, what could be the process? So the process is enforcement of security interest. What is the security? The property. So they will enforce that security interest. Enforce means try to sell off that security. Now, what is their interest? Because the bank has an interest in that security. Bank has got the interest in that security, and to recover that interest, not the interest, the financial interest. Interest means you have some right. Where you have a right to in that particular security, the property, you can sell that property to recover the amount which is outstanding in the books of the banks or the ARC as financial asset. That is why the word SARFAESI, friends. Now, with this background of the whole process of SARFAESI, let us go ahead and understand again a broader picture of when SARFAESI will be invoked. When SARFAESI will be invoked. When will this act be, coming into this whole movie of, process of liquidity, providing liquidity in this illiquid market? SARFAESI will enter when there is a debt. We all agree, we all understand what is a debt. Again, but we'll understand the technical definition of debt. Along with the debt, there should be a default. That means the borrower is not able to pay the money. Along with default, there should be an NPA classification. That means there could be a default of 1 day, 2 day, 3 day, 5 day. It may happen because of certain normal business conditions also at times. So will that be counted as default and SARFAESI could be invoked? Answer is no. So there has to be default, and after default, the account is classified as an NPA as per the RBI norms. There should be a financial assistance. That is there should be some kind of debt or something like that, and whatever has been defined under financial assistance. So debt and financial assistance are one and the same things, but yes, debt is defined separately, financial assistance is defined separately. And more important, friends, very important, it should be secured. It should be secured. That means SARFAESI will only be invoked only in case of secured loans. Unsecured loans will never fall under SARFAESI. So the question should come into your mind, friends. Whether the bank gives an unsecured loan, yes, there may have certain products which are unsecured. It may happen. NBFCs, they give a lot of unsecured loans. So whether NBFC will fall under this category of SARFAESI, why not? Obviously, we'll see if there are certain additional guidelines given by RBI or government within the SARFAESI Act that SARFAESI Act could be applied to NBFCs. So a lot of NBFCs gives unsecured loans. So whenever there is unsecured loan, they keep in their mind that we cannot take the route of SARFAESI to recover the amount. So once it is clear that the whole process of securitization, reconstruction, and investment, let us now understand the various definitions and relevant provisions. As I said, there has to be a debt. Now, what is a debt? So debt has been defined under this Act. And further, under the SARFAESI Act, it says that it includes unpaid portion of the purchase price of any tangible asset given under financial lease or hire purchase or conditional sale. So any unpaid portion of the purchase price, that is also a debt. Right? So Then second, it should also cover any right, title or intangible assets. Remember here the first was tangible, intangible asset, which secures the obligation to pay any unpaid portion of the purchase price of such intangible asset. So if you have purchased an tangible asset or an intangible asset and you have not been able to pay the amount in whole, then whatever unpaid portion is remaining with respect to that particular tangible asset, whether it is given on hire purchase, financial lease or conditional sale, then that particular unpaid portion will be regarded as debt also. That will be regarded as debt also. So that means normally debt is a loan given. Along with that, if you have taken up an asset which is given on lease, hire purchase, and to that extent that particular lease transaction, hire purchase, and that there is some unpaid portion for purchasing that particular tangible asset which has been given on lease, so that is also regarded as debt. Default means non-payment of any debt. Debt has been defined, or any other amount payable by the borrower to any secured creditor, consequent upon which the account of such borrower is classified as NPA. So non-payment of any debt or any other amount payable, any other amount, right? So it may be debt, and along with debt there could be anything. Now what could be that anything? Let's say the processing charges of the loan which has been given. So that could be any other amount payable by the borrower, or when the account gets converted to NPA, there could be additional charges levied by the bank. So that could also be the amount payable by the borrower. Then default will further mean whom? Very important, friends. Very important. Second point. With respect to debentures. Second point is with respect to debentures. As we all know that even debentures are secured loan given by investors to the company. So will that be falling under SARFAESI? The answer is yes. Very important, relevant from exam perspective, because the question could be framed that the company has issued bonds, debentures to the investor. Will this whole process be falling under SARFAESI if in the case of default? The answer is yes, because under the definition of default, it is covering non-payment of any debt or any other amount payable by the borrower with respect to debt securities. But the condition is that notice of 90 days demanding payment of dues is served upon by such borrower. And who will do that? Who will do that, friends? Very important. Who will do that? Debenture trustee. Debenture trustee will give a notice to the company that they are not able to pay the loan, not the loan, let's say debenture repayment interest, then that could be considered as default, right? So the conditions are the amount due should be in the nature of debt and classified as an NPA, and in case of debenture, 90 days must have been elapsed and a notice must have been served. Now what is a NPA? And we all know that it is a classification norm given by the bank. So in case of such bank or financial institution which is administered or regulated by an authority, that is the RBI, and in any other case in accordance with the directions or guidelines related to the classifications given by RBI again, right? So let's say if in case of a bank it is RBI, for any other case if it is any scenario where it is not governed by respective laws, then issued by RBIs. So even if there is a default, friend, remember, even if there is a default, it cannot be classified as NPA, so it cannot be resolved through this particular act. Coming to some other definitions of financial assistance. As I mentioned, 5 conditions. So we are going by the 5 conditions. We have understood debt, we have understood default, we have understood what is the NPA. Now we come to the definition of financial assistance. Financial assistance means any loan, advance granted, or any debenture or bond subscribed, or any guarantee given, or letter of credit. That means all non-fund based. I hope you understand the concept of non-fund based, friends. Guarantee or LC is also covered under financial assistance, though it is not fund based, but still it could be converted into fund based in the event of default. Or any other credit facility extended by any bank. So there could be various forms of credit facility. So that is also covered under the definition of financial assistance. So these are the 5 definitions, friends, secured creditor. Secured creditor. Secured creditor means whom? So secured creditor means any bank or financial institution or any consortium or group of banks. Now you understand what is a consortium and a group of banks. So it could be known as consortium finance and multiple bank finance. You must have heard during your audit, or when you are doing an audit of a big company which has taken loans from different banks. So when the different banks gives loan to a particular borrower company, it may be in the form of a consortium. Consortium means it is a pre-decided arrangement between 2, 3, 4, 5, 6 banks. They come together to finance a particular borrower, come together. Or they may not come together and give loans individually. So that is multiple banking. But when they come together, that is a consortium, where they will appoint a particular bank as a lead bank, will take the lead in the giving the loan, executing documents, and so on, and rest would follow accordingly. So secured creditor, where any bank or financial institution holding any right, title, or interest upon any tangible or intangible asset, friends. Remember, both are covered, any tangible asset or intangible asset. So as I told you, we have a right, a title. So it can be done by a mortgage, creating a charge under ROC as per the Companies Act. So that gives you a right, a title. So we create a mortgage and register it as per the state laws. We create a charge in the ROC that gives you a right and title. In case of debenture trustee, who is a secured creditor, so trustee appointed by the bank if the debenture has been subscribed by the bank, and if the debenture has been subscribed by individual, so registered with the board appointed by any company. So the company may appoint a debenture trustee as per the regulation. And an asset reconstruction company. So friends, remember, a secured creditor is whom? A trustee, bank, and asset reconstruction company. They are the secured creditors. Because under the law, only secured creditor can act under the SARFAESI Act. So 3 people, remember: bank, trustee, and asset reconstruction company. In short, PACT. bank, financial institution, asset reconstruction company, and trustee. Trustee, two types: trustee appointed by the banks or trustee appointed by the company. So these are the 5 definitions which will actually are preconditions for invoking the SARFAESI Act. Now some other definitions which are again relevant from exam perspective. So under the definition, the word SARFAESI, we saw that word, we understood that word asset reconstruction. So it has been defined. What is asset reconstruction? Means acquisition by any securitization company or reconstruction company. What is a securitization company? ARC could be a securitization company. Of any right or interest of any bank. The bank has a right on the borrower's security. Against what? Against any financial assistance for the purpose of realization of such financial assistance. So asset reconstruction, where we acquire any right, let's say right from the bank. Why do we want to acquire the right of that particular bank? So that we can realize the amount for the financial assistance which has been given by the bank. And who will do that? So that will be done by the asset reconstruction company. Means any company registered with RBI under section 3 for the purpose of carrying on the asset reconstruction or securitization. Remember, ARC is not a banking company. That means it cannot open a savings account, fixed deposit account, right? Remember, so that is why it is not a regular banking company, though it is regulated by RBI. Borrower, I think we all understand who is a borrower, so I would not go into details of definition of borrower. Financial asset, yes, very important, friends. Financial asset, what is a financial asset under this particular SARFAESI Act? As I mentioned, explained the word financial asset. So it is a debt from the borrower's perspective, but a receivable from the banking perspective. I had explained this concept. So financial asset is any debt from the banking perspective secured by, as I mentioned, that all the debt has to be secured. Mortgage of or charge on immovable property, right? Remember, immovable property. Then mortgage charge, hypothecation of movable property. Right or interest in a security underlying a debt. So it could be any other security other than movable, immovable, or movable. Then it could be a beneficial interest in a debt in a property, whether movable or immovable. So that means you don't have that particular access. Let's say, for example, a property has been given to 2 banks. Both understand, yes, this property is against this particular loan. So I have a share of 40%, the other bank has a share of 60%. Then beneficial interest to the extent of 40% in a debt. That is again regarded as a financial asset. Then beneficial interest in any intangible asset. Any intangible asset which is given on hire or purchase or financial lease or conditional sale. Then a contract which secures the obligation to pay any unpaid portion of the purchase price of such asset, or an obligation incurred on or credit otherwise provided to enable the borrower to acquire such tangible asset or intangible asset. So these two have been to be taken clubbed together. So we have discussed this particular part under the debt. that if there is any unpaid portion on any tangible and intangible asset which has been acquired and which has been given further on hire purchase or lease, and I create a beneficial interest on those particular tangible and intangible asset, that is also regarded as a financial asset. And any kind of financial assistance, is also regarded as a financial asset. So to classify under financial asset, the conditions are many, and broadly it covers every type of particular loan given by the bank. So first it is debt secured by, that is a financial asset. Right or interest in a security, that is a financial asset. Beneficial interest, not a direct interest, but a beneficial interest. I've given you the example. In a debt, right, or in a property, whether movable or immovable. Then a beneficial interest in any intangible or tangible asset. In an intangible asset which is given on hire purchase, lease, or conditional sale. And the last, the definition of financial assistance. So financial assistance, we have already understood that it covers further broad category. Financial assistance, I think we have covered. Right, here we have defined what is financial assistance. So that is this financial assistance means any loan or advance granted or any debenture, right, or guarantee or letter of credit. So that means an asset which is not a financial asset. That is why this definition of financial asset is very important. If an asset which is not a financial asset cannot be securitized, acquired, or transferred under this act. That is why we need to ensure that the criteria is financial asset. Example could be a value of an unsecured land in the balance sheet of the borrower cannot be acquired by an ARC by way of issue of security receipts. Remember, so that is not a financial asset because it is unsecured. Then I had mentioned the word QIB, qualified institutional buyers. Who are qualified institutional buyers? Let me again go back to this process. Qualified buyer. I had explained this word, what is a qualified buyer. So qualified buyer is it could be a non-institutional investor specified by RBI. Then asset management companies under the mutual fund. SIDC, there are a lot of state development corporations. Insurance companies, financial institutions, foreign institutional investors, Then they have financial institutions. Then the banks are there. The ARCs are qualified institution buyers also. And the state financial corporations. There are, within the state, there are a lot of finance corporations to promote the small and medium sectors. So they are also a qualified institutional buyers. Job, they will give money to ARC against security receipt. They will give money to ARC against security receipt. Why the importance of QIB? ARC cannot raise funds from investors who is not a qualified buyer. So that means if a manufacturing company or a company like TCS, they have surplus funds, can they give money to ARC? The answer is no. They cannot give money to ARC. What is securitization? It has been defined and we have understood. When I explained the whole chart, that whole process is a securitization process, means acquisition of financial asset. We have understood what is financial asset, all the right, interest, beneficial interest on all the, was the right on the movable property, immovable property, right of debt in any security, beneficial interest in intangible asset to the extent of unpaid portion, any kind of financial assistance. So means acquisition of financial asset by ARC from an originator. I think we all know what is now originator, what are financial asset, what is ARC, whether by raising of funds by such ARC from qualified buyers, by issue of security receipts representing undivided interest in such financial assets or otherwise. So we now all know the terms under securitization, and now we come to this conclusion of the first angle of this act, that is covering the definition and the process part. So before we get into the process, the last definition is security interest, because we have to understand the whole word of enforcement of security interest. So what is security interest? It is in general the right, title and interest of any kind. So very common definition: any right, title, interest on what? On any mortgage, charge, hypothecation, which normally is given by the borrower to the bank, on the tangible assets, right? Then if the asset, let's say, for example, when I mentioned the hire purchase of financial lease, what could be the possible transaction? So let's say Tata Motors develops a car. It gives a car to Tata Capital. Tata Capital is a financing company. Tata Capital in turn gives that particular car to a particular borrower, and that borrower passes on that car to a driver of Ola, who takes it on hire purchase and lease. Right? So if in this transaction where Tata Capital has given a particular car to a borrower, who further has given a car to any Ola driver on hire purchase or lease, so Tata Capital will have a beneficial interest on all that hire purchase and lease transaction. Though it is not directly given a loan to whom? The Ola driver. But it has given a loan to the borrower, who further has given a particular that tangible asset to a Ola driver on hire purchase or lease. So it may be related to a tangible asset, or it may be related to an intangible asset also. So Tata Capital will have a right over that particular car, even though it has been given on hire purchase by the borrower. Because the borrower is not able to pay the whole purchase price of that particular asset. So when the borrower is not able to pay the purchase price of that asset, how will I recover that amount? Because that particular asset has been given further as a lease to a particular Ola driver. So I should have a right. So that security interest is given under the SARFAESI Act. So unpaid portion, I think this is a common term which is already being used in all the definition of financial asset and financial assistance. So I've given you the example that what does the unpaid portion of the purchase price of the asset means when that particular asset has been given on hire purchase and lease. So it includes both the part, on the tangible asset as well as on the intangible asset. Now remember, it should be financial asset and it should be secured, and here the importance of a creditor shall not be called as a secured creditor unless its interest over the assets or the borrower is covered under the above definition. So in general, any right interest on right, title and interest of any kind, and will include these two things. So remember the word first is RIT or ITR. Remember always these three words. ITR. We all know what is ITR now, income tax return, but here it means interest, title and right. So whenever the word security interest the financial assistance, financial asset, these two definitions will come in. So always write down these two words. Right, interest and title. Interest, title and right. Right? So I think these are some important things which you should note down in your copy when I'm mentioning certain small mnemonics which are quite relevant in remembering, recalling these definitions and using it in a proper language when you have to write down the answers in the exams. Let's take one example. And the question is, Akash Limited has issued listed bond 5 years ago, which is due to be redeemed in the current year worth 50 crore. The projected cash flows and profitability of the company seems inadequate to repay the bond. Cloud Limited holds bonds worth 20 crore and wants to explore its options under the SARFAESI Act. Please advise Cloud Limited for the remedy available. So, see, I am trying to cover the question from the topic which you have covered so far. Right? But in exams, it will not be topic-wise question. If this question comes when you have studied the whole SARFAESI, then how do you relate to which particular section it applies? What do I need to answer? Because in the question, it is an open question where it is not asking any specific section that as per section 14, as per section 13, what is to be done under SARFAESI. And that creates a problem, friends. And that is why I said, for this you need to have an understanding of the macro picture and understanding when this act will come into the picture, when it will enter in this whole movie. The story will unfold, the story will be written later on. But first, let us understand how this entry will be done. So friends, because it is an open question, so it is asking for a remedy. Now, remedy is under SARFAESI. Remedy under the SARFAESI. Now, we all have come to know by this time that when will SARFAESI be invoked? When will SARFAESI be invoked? So, SARFAESI will be invoked when? Again, going back to the basic term, friends. When there is a debt, there is a default, and default is an NPA, and obviously it should be a financial assistance, and it should be secured, right? So here the scenario is what? A bond, and normally, as I said, bonds and debentures, they are always secured. So it is a debt, it is a secured debt, there should be a default and NPA. Now, anywhere is it written whether the default? It is only written that it seems to be inadequate to repay the bond. So as such, in the current scenario, it is not a default. But to advise Cloud Limited, what we can say that in case of default, but default in case of what? Is it a loan given by the bank? Answer is no, it is not a loan given by the bank, but it is a debenture or a bond. So is that covered under debt? Answer is yes. There's a default. Yes, if there's a default and 90 days notice when from the date of default, when the company is not able to repay the loan, a notice for 90 days has to be given, and once a notice has been given, after that, if the company is not able to pay the bond holders, then the remedy under SARFAESI is available. Then the remedy under SARFAESI is available. So this question basically is trying to ask you whether SARFAESI will be applicable to this particular investor or the debenture holder. Obviously, he will not apply directly. Through the debenture trustee, he is going to give the notice, and thereafter, if there is a default, even after 90 days, the default continues, then it will be invoked and the various provisions can be acted upon. Another example. Very important. See friends, understanding the provision, applying the provision. That is to be taken care of. Understanding is one part where a lot of people do understand, do learn the definition. But in exam, the biggest problem is you have to apply the understanding. And that's where a lot of students fail to apply the understanding part because they have not understood what, I'm not talking about concepts, the overall picture of the act from the source level. So the question is, nationalized bank has provided a term loan of 20 crores to Allwell Pharma Limited at an interest of 12% per annum, and the principal amount is payable in equal half-yearly installment of 2 crores in 5 years from the date of disbursement of loan. The loan is fully secured against the plant and machinery of the company. The company was regular in paying 3 half-yearly installments along with interest during the first 2 years. Due to recession in the market and increased competition from MNC, the price of the manufactured product had fallen down and consequently the company had to close down the plant. Hence, the company failed to pay the 4th installment, but it paid the interest when it was due. Installment was not paid, interest was paid. After a period of 2 months from the due date of the loan, the bank decided to sell the loan to ARC. Good, that is an option available, yes. So they decide to sell the loan. It also decides to sell a loan of 50 lakhs given to a farmer, which is secured against agricultural land. So leave aside that because we have not covered this concept, though it is not in your course. But let me tell you, agricultural land are not covered under SARFAESI. Remember, agriculture, this is part of section 31, which is not in your course. Agricultural land are not part of SARFAESI. So obviously it cannot be done. The bank manager seeks your advice on the above for proposals. Okay, so as an advisor, friends, you get a business opportunity and the bank knocks on your door and tells, please let us know what has to be done. So again, going to the basic condition, friends. Debt, yes. Financial assistance, because it is a debt and we have a security interest in that because it is still secured. You see the conditions. Fully secured against the plant and machinery. So there is a debt. There is a financial assistance. It is fully secured. And is there a default? The answer is yes, there is a default. And after the default, if the account has been classified as an NPA, so as per the NPA classification norms, it is said that 90 days of disorder. How many days, friends? So you are trying to club the provisions of NPA classification also. So 90 days of disorder. So here it is mentioned after a period of 2 months from the due date of loan. Bank decides to sell the loan to ARC. So that means the bank is not waiting for 90 days to be classified as the account as NPA. And before that 90 days, it is trying to sell that loan. Whether that should be allowed or not. That could be allowed, but not under SARFAESI. They can sell the loan to whatever mode, but then under SARFAESI it will not be applied. So friends, so under SARFAESI, the bank manager as an advisor will give the advice that under SARFAESI you cannot do that, sell the loan to ARC, and therefore you cannot invoke the provisions of SARFAESI. So we would advise the bank manager not to sell the loan, wait till 90 days, till the account is classified as an NPA, and thereafter take further actions. So I hope these 2 examples will again make your thought process more clear, that how to look at the questions, applying the provisions to the practical scenario. Now we come to the actual implementation part, how this process will be implemented. Good. The first, from section 3 onwards, it is talking about the ARC world, the world of ARC. So the ARC has to be registered. Yes, they will be registered. Who will do the registration? Who can apply to be classified as an ARC? So any company can commence or carry on the business of securitization or asset reconstruction, but with the condition that they must obtain a certificate of registration. That means they should have a certificate of registration under this particular act, and who can become, qualified, who can be eligible. So the person who is eligible is a person of having a net owned funds. Net owned funds of not less than 100 crore or such higher amount as the RBI may specify, which is now, as per the RBI guidelines, 15% of the financial asset. 15% of the financial asset. So this is a basic financial criteria. I would term it as a financial criteria. Now, what is net owned funds, friends? Is it defined under SARFAESI? Answer is no, it is not defined. So we need to take a reference for RBI guideline. As per the RBI Act, net owned funds have been defined. So as per the definition of the RBI, we will have to calculate the net owned funds. And we all know what could be a possible way of calculating net owned funds is basically nothing but creating a net worth. So it could be the paid up share capital, the free reserves, minus the any miscellaneous expenditure and so on. I'm giving it just a general concept, not the exact definition of calculation, but then just trying to correlate with the financial world that what could be the possible way of calculating the net owned funds. So if you have this net owned funds, then you are eligible to commence the business of ARC. But then you have to take a certificate from RBI. So you need to apply. Obviously, for taking a certificate, you need to apply. So they will make an application. Sorry. So they will make an application, and in that application, further conditions have been given. When you make an application, the further conditions RBI will see that the ARC is not incurred losses in any of the 3 preceding financial years. That is another condition. Then ARC has made all the arrangements for realization of the financial assets which they have acquired from the banks, and they shall be able to pay the returns to the qualified institutional buyers. How will they pay the qualified buyers? Obviously, they have to give certain returns because qualified buyers has given the money to ARC. So adequate arrangement must have been made by the ARC. Now, what is an adequate arrangement? Now, that is subject to inspection, verification by RBI, whether they have the requisite people, requisite staff, requisite infrastructure, requisite qualification. That is the way the arrangement for realization could be judged. Then the directors have adequate professional experience in matters related to obviously finance, securitization, and integration. So like an ex-banker could do that, can start this ARC company. And obviously the directors have not been convicted of any offense involving moral turpitude. And that is sponsor. Very important word here comes. Who is a sponsor? Sponsor is a person who provides money. And as per the definition, it could be 10% of the equity capital of ARC. So that can be a sponsor. So there is a person who starts this concept of ARC, and then he tries to arrange for funds. And funds from where? Funds from sponsors. So we'll bring in various sponsors to become the part of the ARC. And in general words, we can term it as equity investors. And equity investors are termed as sponsors in the world of ARC. So the sponsors of ARC are a fit and proper person in accordance with the RBI guidelines, and ARC has complied with or in a position to comply with the prudential norms. So that means ARC is not defaulter anyway. And ARC has complied with one or more conditions specified in the guidelines issued by RBI for this particular purpose. So is it relevant for the exam part? Answer is yes. You need to learn this. What are the conditions for registration? Conditions for registration. So in all, there are about 6 to 7 conditions, along with the basic conditions of net owned funds of 100 crore or such higher amount specified by RBI, which is equal to 15% of the financial asset, friends. Okay. Then once the registration has been granted by RBI, then the ARC has to follow certain regulations, and for doing certain things it has to take a prior approval. Again, relevant from exam perspective, because a direct question could come in with regard to what are the prior approval required by the ARC from RBI. So I think very general. When the substantial change in its management, the board is changing, the directors are changing, including appointment of any director, managing director, or the CEO, a change of location of its registered office, or change in its name. So general thing, and decision of RBI should be binding. Yes, very important. Again, can the certificate of RBI given to the ARC can be cancelled? Answer is yes. When it ceases to, first, obviously when it ceases to carry on the business of ARC, then it has to close down, natural. When it does not has the arrangement of bringing in funds from the qualified buyer, that means there's no qualified buyer who is willing to give the funds, because as per the past experience, it has been shown that the ARC is not able to give sufficient return to the qualified buyers, and therefore the qualified buyers are not willing to provide more funds. Then it has to apply for cancellation, or automatically it will be getting cancelled by RBI, or has failed to comply with any of the conditions of certificate of registration. So we have seen there are 6 conditions. So they have failed to comply with any of the conditions, or has failed to fulfill conditions referred to in clause A to G of subsection 3 of section 3. Again, that is the 6 conditions, and along with that, net owned fund condition. So the first part will basically cover the net owned fund condition, and the second part will cover the A to the 1 to 6 conditions. And third is when they have failed to take a prior approval wherever required, right? So very important is they have to take a prior approval. Or fail to maintain accounts, submit or offer inspection is booked for accounts, comply with any direction issued by RBI. But before cancellation, both will be given. What is both? Opportunity to be heard. BOTH, opportunity to be heard, friends. BOTH, opportunity to be heard. Remember, friends. So this is the conditions for cancellation of certificate. Very important, relevant from exam perspective. If the registration is cancelled, do the option of appeal is available to the ARC? The answer is yes. The ARC may file an appeal, obviously within 30 days from the date of communication of order of cancellation. An appeal will be made to whom? To the central government, because the cancellation is done by RBI. There is no such regulatory authority again apart from RBI. So where do we file an appeal against RBI? So we have to approach the central government. So there will be a Ministry of Finance, let's say, where we have to file an appeal. What after that? If when the central government rejects, we may go to Supreme Court if possible. But okay, so that is the normal process for any order against the RBI part. So X Limited is in ARC. The certificate of registration granted to it was cancelled. The state, the authority which can cancel the registration, and the right of X Limited against such cancellation. I think we all know now that who the authority to cancel the registration would be by the RBI, because the conditions are that we ceases to carry on the business, receive money, has failed to comply with conditions mentioned at the section 3, then has failed to take a prior approval, or then maintain account, submit or offer the books of accounts, comply with direction issued by RBI, then registration could be cancelled. I think some mistake in the question. This answer is A. This is one and the same thing here. Okay. So for this particular MCQ, RBI specified the net owned funds for asset reconstruction can be minimum, obviously 100 crores. So before granting a certificate of registration, the RBI shall itself satisfy that the company has not incurred losses in any of the 3 preceding financial years, correct? No director of such company is convicted of moral turpitude, yes. Then the company has been complied with or is in a position to comply with the prudential norms, correct? So all of the above. So if the registration certificate of ARC is cancelled, how many days will it require to make an application to RBI? So we have mentioned that it has to be done within 30 days. It has to be done within 30 days. The answer is 30 days. One of the following ground is not the criteria for cancellation of registration certificate of ARC. First criteria, ceases to carry on the business. That is a criteria, correct? Has failed to comply with the conditions specified by RBI. That is a criteria. Fails to maintain the accounts in accordance with the requirement of the Act. That is a criteria. Has incurred losses in the preceding financial year. Criteria is 3 financial years. 3. D is the correct answer, friends. D is the correct answer. The appeal against the cancellation of RBI can be made to whom? So it can be made to, as I said, yes, I think everybody should get it correct. Those who are watching it, central government. Good. So Ranveer Limited is an ARC. The company has failed to comply with any direction issued by RBI. Under the provisions of the Act, what action will RBI take now? Because he has failed to comply with the direction issued by RBI. That is one of the conditions for cancellation of the certificate. Cancellation of certificate. Okay, now once the registration is granted, friends, let us move ahead and understand the process how the ARC is going to acquire the financial assets of the bank. So the process is, before we take a break, let us understand the process and then we'll take a break. The process is that it can be acquired by issuing debenture, bond or any other security as consideration. So the ARC will issue the bonds to the bank as a consideration or by any agreement between the company and the bank for the transfer of financial asset. Right? So that is the normal mode of acquiring the financial asset. And remember, when this acquisition takes place, then stamp duty is exempt. just to encourage the whole flow or encourage the banks to participate in this whole process. So the concept very simple. If that particular asset has to be transferred, it has to be through an agreement or by issue of debentures or bonds or any other security. So in this way, the securities, the financial asset are transferred. So two mechanisms, remember, two mechanisms, number one and number two. What will happen once the rights or interest are transferred? That means now bank has transferred that particular right or interest. What is the consequence? What is the consequence? So the consequence is that now the ARC will be termed as the lender. Till now the bank was the lender. Now ARC will be termed as the lender. And whatever rights the bank had as a lender will now vest on the ARC. The rights of the bank will be transferred to the ARC. That is the first impact. Then any right, title or interest upon any tangible or intangible asset will now again be vesting on the ARC. So friends, what I would suggest, you should learn these lines which are very common. We have seen since the definition part that right first is ITR, right, title, interest upon what? Both tangible or intangible. That is the second thing which we break. So we break here tangible or intangible. Remember, how do you frame your answers when you have to write down the exam? So write ITR on TAT. TAT is tangible and intangible asset, right? So yes, TAT could be done to secure payment of any unpaid portion of the purchase price of such asset. That is right. That is the third part. Or an obligation incurred or credit otherwise provided to enable the borrower to acquire that tangible asset. So that is the fourth part, which you also should remember. Because these are common words which are being used in financial assistance, financial asset, and debt. These are the definitions. So here also, so whatever right which it had on any tangible, intangible asset will be transferred, friends. So here we take a small break. Jay sir, can we take a small break and then restart? Jay sir? Jay sir, are you there? हाँ 5 minutes break ले लें. Right, friends, welcome back after this small break. I've received few questions which I would like to have further clarification so that you can pose the questions again. The first question is from Ambika. He has asked, does trust holds all share of ARC? I never mentioned about that trust holding all the shares of ARC. I think there is some confusion regarding the holding of shares. Can you, if you can give further, clarification on your question? But as such, trust does not hold all shares of ARC. In my structure, I never mentioned that. Now, the second question was from Gigi Chose from Kerala. The question is whether security of debtors normally given as security against LC will come under secured tangible or intangible asset. I did not get to whether security of debtors now under LC. Who gives the security of debtors under LC? I think if you can further clarify your questions, I'll make it clear. Normally, as LC, that will come under tangible assets. Then again, same question. Debenture trustee, whether similar to ARC but appointed in case of debentures or whether similar to ARC but appointed. Debenture trustees are basically appointed by either the institution, if the institution is the investor of those debentures, or if the retail investors are the investors, then it is appointed by the board, the debenture trustee. So I've explained the concept of debenture trustee. You can ask further on that. Then again, ARC cannot be banking company. Yes, they cannot be a banking company, but most banks have ARC, correct? So they have a ARC which is a separate company. So your question is correct. Most banks have ARC, but that is in the form of a separate company which is registered under RBI as per the guidelines, and they cannot do the work of banking. Yes, separately registered apart from bank, correct. Okay, so I've answered the questions. So let's move ahead, friends, and understand the consequences of acquiring financial asset. Very relevant, friends. So we have understood what is the ARC, the registration required, and what are the steps taken to acquire financial asset, and then what are the consequences for that. So we have understood the consequences is that the ARC will become the lender, and it will give all the rights, vesting rights to the ARC, and then whatever contracts, deeds, bonds, agreement, documents have been executed by the banker. Now, in that, the name of the banker will be transferred to the name of the ARC. So that means now the document's name will carry the ARC, and going forward, it will be executed by the ARC. Right? So it will be deemed that this document has been issued by the ARC from initial level. There are situations, that there might be cases which are due against that particular financial asset. Cases may be related to the borrower might have filed a case with respect to that particular financial asset at some forum. Whether those cases will continue, the answer is yes. So the cases would continue, and they will be continued in the same way it has been doing. So there's no such relaxation that the cases will be stopped. Then if the cases are being pending at any of the forum, be it any tribunal, be it any court, then the ARC would apply to those courts that please change my name, please change the name now, that from the name from the banker to the ARC part. So the possible question which can be coming in the exam could be that what are the consequences once the ARC takes over their financial asset? So it could be a descriptive 6-mark question. So you have to refer section 5, friends. 6-mark question of the different consequences, the impact of acquisition of financial asset. There might be scenario when the borrower has taken multiple loans from different banks, and there might be certain cases which are pending at different courts. So let's say a bank is situated in Delhi, some banks are situated in Mumbai. So the borrower has taken loan from bank in Delhi, bank in Mumbai, and the cases might be pending at respective courts in Mumbai and Delhi. Then what will happen? Then the ARC may file an application to the appellate tribunal having jurisdiction of such tribunal, that you could transfer all the applications to one DRT. That might be a possibility. So they can do that so that the administrative part becomes more easy. So that is a possibility. Okay, so the obligor and the role of the banks and the ARC to the borrower, what they have to do. So once the asset is being taken over, the bank financial institution may give a notice of acquisition of financial asset by any ARC to the concerned obligor, that is the borrower or the surety. Now, who is the surety, friends? The person who has given a guarantee also, that he has to be informed that now the loan has been transferred from the bank to the ARC. So that is another next step. So section 5 and section 6 have to be clubbed together, that what are the steps to be taken by the banker or the ARC and any other concerned person, and to the concerned registering authority also. So let's say your charge has been registered with SARFAESI or charge has been registered with the ROC. So you need to inform all those registering authority that now the charge should be given in favor of the ARC. And going forward, the borrower or the surety will make the payment to the concerned ARC with discharge with respect to the discharge of all its obligations. So that is section 5 and section 6 for all of us, friends, which will talk about the steps to be taken by ARC and the banks. Now, once these assets are taken over, what could the ARC do? What could the ARC do? That is very important. Okay, friends, so there was a slight disturbance. Now, once the ARC takes over the financial asset, a very important section of 6 marks. Remember, the steps taken by the ARC for reconstruction, that is actually the main provision under SARFAESI. How do you reconstruct that particular financial asset? And that is given under section 9. So if a question comes in from the holistic point of view, the first thing which should strike in your mind, so when a question comes in, first thing which should strike in your mind is first, whether SARFAESI would be invoked or not. So we have seen the conditions whether SARFAESI would be invoked. So that we have seen. Second, if the SARFAESI is invoked, what are the steps? Steps taken for what? For taking over the financial assets, section 5 and 6. Section 5 and 6. How do I take the asset? And once I take the asset, how do I reconstruct? So section 9, reconstruction would come in. So that is a improvement measurement. First is taking over and now the improvement part. So the improvement could be done by proper management of the business of the borrower, by changing or take over the management. So that means now the old management goes out of business. Old management goes out of business. Then we can sell or lease off a part of whole of the business of the borrower. So it may be a possibility I can sell a part or whole of the business. That is possible to realize the money. Then I can do a reschedulement of debt. That is a possibility, right? So reschedulement of debt could be possible. So I would underline P, sale or lease, reschedulement, then settlement of dues payable by the borrower. So we can do that settlement. We can take over the position of the secured assets as per the regulation. We'll come to know section 13, position of the secured asset. Then we can convert any portion of debt into shares of the borrower company, and we become the owner of the company. We have taken the management. We are not the owner. Management is there, but we can become the owner also. So there are 6 steps which could be taken. Either we take the management and run the business, we sell the business, right? Then we reschedule the payment terms, we settle the dues at particular price, and we take the position. Either we acquire all the assets, we take the position in accordance with the provisions of this act, and either we convert the debt into equity. All these all 6 measurements are possible. So very important, 6 measurement. So if you want to mark the word P, S, R, SPC. SPC. So P is proper management, S for sale, R for reschedulement, S for settlement, P for position, and C for conversion. So section 9, very important, friends. Then, apart from the main functions of ARC, can ARC do some other function? Yes, there could be possibility of other function. That is RAM, remember, as a receiver. If the court appoints the ARC as a receiver, that means only to receive the amount, not to pay off the liability, only receive. Then can work as an agent, recovering agent. ARC could work as a recovery agent. That means the bank will appoint the ARC that your job is only to recover. I will go and recover. And they will charge a fees. As an agent A. And as a manager. So my job, the bank could give me the job of the management part, where we have to manage the secured asset, which has been taken over by the secured creditor. That is, the bank has taken over. I just need to go and manage that particular asset. Right. So the job could be the RAM part. Other functions of ARC, apart from taking over the financial asset and doing the reconstruction, we can have individual job responsibility also. That is section 10, other functions of ARC. If you carry on any other business, that is not allowed. And okay, now if there is a dispute between whom? Between the bank, the financial institution, and the ARC and the qualified buyer. There could be a possible dispute regarding the non-payment of any amount due, including the interest part. There could be a possible way. So that can be solved only by Arbitration and Cancellation Act. Very important act, friends. Very relevant in the current scenario. Going forward also, it is going to play a very important role in the whole economic development of this country. So resolution of dispute, first time I think you must have heard of this, that if there is a dispute, then we don't need to go to any court. we just need to go for arbitration and conciliation. I'll come to this power later on if time permits. I'll focus more on the next section 13 to 19, and then we'll take few cases also. So let me first cover this and then we'll come to this power of RBI if required. So now the second part of the SARFAESI is enforcement of security interest. So we have seen the first part, securitization, how the assets will be transferred. So assets are being transferred, that is done, section 5. Then section 9, how reconstruction will be done, 6 techniques, that is RFA. And now we come to the last part, ESI, enforcement of security interest friends. And under this enforcement of security interest, 2 sections, very relevant and very important. 2 sections. I mean, in altogether there could be 3 sections. 13, 15 and 16. Yes. 13, 15, 16. And within 13, we have 2. 13.2 and 13.4. Within section 13, we should concentrate on 2 provisions, 13.2 and 13.4. Please make it a point. See, if you recall, if you please highlight these important things, I think at the last minute revision, you just refer to these provisions. Probably most of the questions which are asked in the exams relate to provisions around this, high probability. So enforcement of security interest means where I can go and enforce my interest, which we have understood what is the security interest. So my interest is that in the property, in the asset. So I can now enforce. Enforce means I can go and sit. I can have my right. So I can go and sit on that particular property, tangible asset, intangible asset, movable, immovable, whatever. Can I do that? Answer is yes. Under SARFAESI, it gives you the right. Will the court not come into the picture? Without the intervention of court or tribunal. That's what I was saying. More power to bank. Though the bank has been asking for more things, ye dil mange more, but the government says now, this is more than enough what we can give to you. Is that without intervention of the court, you can go and sit on that property. But when? When can you do that? Who will do that? Bank? Yes. ARC? Yes. So the bank, financial institution, ARC, they can all go under this section. So when they can do that, so wherever a borrower, where any borrower who is under a liability to a secured creditor, under an agreement, makes a default in respect of secured debt or any installment, and his account has been classified as an NPA, then the secured creditor may require the borrower by notice. He has to give a notice. So normally when you go into the world of banking, legal department, recovery department, they will refer only one, 13.2 notice. Have you issued 13.2 notice? They will ask in this terminology. So 13.2 notice means you give a notice to the borrower asking him to discharge his liability in full. So you have to write down, please discharge your this much liability outstanding on this and this date in full within 3 days. And if you are not able to do that, I will come and sit on your property as per section 13.4. So 13.2 notice is a prerequisite before you go and sit. Is a prerequisite before you go and sit. So you have to give a notice in writing telling this is the amount of loan outstanding. I want to come and sit. Then you would say, sir, what will happen in the case of debentures? There is no such criteria of NPA. Then this particular provision will not apply. The requirement for classification will not apply in case of the funds raised to debt. Then in the case of debentures, in the event of default, the debenture trustee shall be entitled to enforce the security interest. So the content of the notice should contain amount payable. The notice should contain the amount payable by the borrower. And if they are not paying, which are the assets? These are the contents of the notice. You have to specially mention. First, remember, notice in writing, then you have to mention within 60 days you have to pay this amount, so amount payable. And if you are not paying the amount, these are the assets which I am going to enforce. So these are the contents of the notice. What can happen after that? Suppose the borrower, he receives the notice. Mr. Malia receives this notice. So he can repay. He comes and say, okay, I repay. Good. Finish. Everybody is happy. The second, he can make a representation or objection. I raise my objection, my lord, that you are asking too much money and this amount is not correct. And you are asking me have a right to the property. This property is subject to this dispute. I have already raised a point. So make a representation or objection. We will come and make a representation or objection. And the creditor has to work on that objection. And he has to do this, reject within 15 days, giving reasons. Once you receive a letter from the borrower, the bank has to reply within 15 days, compulsorily. He has to reply within 15 days. And the third option, he will not repay it. Creditor can enforce the security interest as mentioned in the notice part. So very important, friends, remember the objection in general as a principle. If you are a consultant to a borrower, tell him to make a representation or objection for ABCD reasons. And if you are on the part of the banker, ensure that the banker responds to that particular objection within 15 days. Now what is going to happen if you are not able to pay the money? Section 13.4. Section 13.4. Very important. This is 13.4. As we have seen, the ARC can take measures, 6 measures if you remember under section 9. What are the measures taken under enforcement of security interest, section 13.4? So remember, under SARFAESI there are 2 solutions. What are the remedies available for realizing the money? First you have to file be under SARFAESI. Second is you give it to ARC, and under section 9 ARC will do whatever measurement. Or third, the banker, the institution or ARC can go for 13.4 for taking the various measurement. So the steps, the solutions are 9 and 13.4. Solutions are 9 and 13.4. Remember, friends. So what can the borrower do? Take possession of the secured assets of the borrower. Obviously, he can take that, including the right to transfer by way of lease, assignment or sale for realizing the secured assets. So he can take the right of transfer by way of lease also, or assignment or sale. Then he can take over the management of the business of the borrower. So same in section 9. Same way the borrower can also do it. So section 9 was particularly related to the ARC. That was in relation to ARC. Here, the borrower, the banker can do it also if they want to take over the management of the business, including the right to transfer by way of lease, assignment or sale for realizing the secured asset. So we want to acquire that right also, that we want to lease it, assign it, it is possible. Provided that the right to transfer by way of lease, assignment or sale shall be exercised only where substantial part of the business of the borrower is held as a security of the debt. Example, if I have given 5 properties as a security and 5 property as a security, and in all I have total around 20 properties under that business. I have 20 properties, and as a security I have provided only 5 properties. Then the right to transfer by way of lease, assignment is not possible, because substantial part is remaining as free. Only 25% is given as a security of the total assets. That is not substantial. In that case, I cannot take the right of lease, assignment or sale. Third, important, these are all important points which you have to remember from exam perspective. Provided further where the management of the whole of the business or part of the business is severable, the secured creditor shall take over the management of such business which is related to the security of the debt. So suppose, let's say the borrower has got 2 divisions. Let's say, for example, they are having cloth manufacturing and retail outlets for those cloths. There are 2 separate divisions, and the security has been given only for cloth manufacturing. Then the borrower can take over the business of only cloth manufacturing. They cannot take over the business of retail outlets of selling those cloths. So it has to be very specific, friends. Third, they can appoint any person to manage the secured asset. As we have seen, ARC is a manager. Ram, manage. So they can appoint a ARC to manage the secured asset and require at any time by notice in writing any person who has acquired any of the secured assets from the borrower and from whom any money is due or become due to the borrower to pay to the secured creditor so much of the money as sufficient to pay the secured debt. Example, if the borrower has given 5 assets to the bank and during the pendency of the loan, the borrower has sold 1 asset to any other buyer and the amount has to be collected from that buyer, then the borrower can ask that particular buyer to pay the amount not to the company but to the secured creditor. To the extent the amount is due to the bank. So they can approach a third party who has some amount due with respect to the secured asset. So friends, 13.4 word is management. possession, management, appoint, and collect money. Collect money. So 4 steps under enforcement, 6 steps for reconstruction, 4 steps, 6 steps. Oh. Then further consequences which can happen once the security interest is enforced. Right with respect to the immovable property. Where the sale of an immovable property for which a reserve price has been specified. So when you sell that property, and normally the selling is done through auction, you must have read in a lot of newspapers, ads comes with respect to the SARFAESI notice that this property has been acquired by the bank and this property is being sold off, and this is the reserve price. If you want the details, you can log on to the bank's website and you will get all the details of the property which they are selling off and mentioning the reserve price. And so they mentioned it is reserve price, and when they sell it for auction, nobody comes in to buy that asset. So it has to be postponed for want of a bidden amount. For want of a bid of an amount not less than such reserve price. So nobody comes to bid. Then it shall be lawful for any officer of the secured creditor to bid for that immovable property. That means here the question could be framed in, can an officer of the bank apply to bid for that particular property? The answer is yes. But the condition is it has to be postponed. So at the first level of bidding, he cannot do that. But in subsequent level of bidding, he can do that because nobody has come in for bidding in the first level. So officer of the secured creditor on behalf of the secured creditor, remember, right? It's not the officer who is there. So authorized by the secured creditor can bid for the property. That means now the property gets transferred to in the name of the bank. So where the secured creditor is declared to be the purchaser of the immovable property and any subsequent sale, the amount of purchase price. So whatever amount is being given by the bank, that amount will be adjusted against the outstanding dues of that particular borrower. In doing all these activities, expenses are incurred. Expenses are incurred. So where any action has been taken against a borrower, all cost, charge and expense have been properly incurred by him, or any expense incidental thereto shall be recoverable from the borrower. And the money which is received by the secured creditor in the absence of any contract to the contrary shall be applied first in payments of such cost, secondly in discharge of the dues of the secured creditor, and the residual of the money so shall be paid to the person entitled according to the rights and interests. So we'll take one example. Example, if the bank takes possession of one property, or not possession, yes, possession and possession of one property and tries to sell it by auction, the fees of auction is 2% of realization. Is 2% of realization. Once again. Yeah, is 2% of realization. The cost of publication in newspaper is 10,000. If the bank has lent 2 crore against the property and the property is sold for 1.9 crore, then how will the amount be utilized? Amount can be utilized. So we need to do the calculation part. So the calculation would be that we will calculate 2% of the fees of auction is 2%. So first what we'll do a calculation. $1.9 crore into 2%. So that comes to around how much, friends? Can anybody give the calculation part? Okay, so let me do the calculation. So it will be equal to what? So 2 crores into 2%. If you want to be very quick, so we can do this calculation. So 3.8 lakhs, friends. 3.8 lakhs is the expense part. And along with that we have 10,000. So 3.9 lakhs is the expense. So 3.9 lakhs is the expense. So what is going to happen? Out of 1.9, first it will be 3.9, which will be deducted. So now the balance is 1.861, right? So something like 1.86. No, 1.51, sorry. 1.51. So 1.51. So this 1.591 would be used for paying off these 2 crores. This 1.51 will be used in paying off this 2 crores after deduction of the expenses part. That is given as per the law. So till the full amount has not been realized. So out of 2 crores, we have been able to realize only sorry, some mistake in the calculation part. 1.9 lakhs, 1 crore 90 lakhs. Sorry. I think some mistake in the calculation part. That just happens when we do the calculation on PowerPoint. So anyway, 1 crore 90 lakhs minus 3 lakhs 90,000. 3 lakhs 90,000. So that will bring the amount as 1 crore 86 lakhs and 10,000. So my initial calculation was correct. So it is around 1 crore 86 lakhs and 10,000. So 1 crore 86 lakhs will be adjusted against 2 crores. 1 crore 86 lakhs 10,000 will be adjusted against 2 crores. So balance will still be left to be recovered. And what can the bank do if the dues are not fully satisfied? So now the bank can approach the tribunal, the court, for recovery of the balance amount. That is possible because still some amount is pending. And what if the property was sold for 2.25 crores? So if the property was sold for 2.25 crores, which is above the amount due from the borrower. So as per the law, it is mentioned that after recovery of the expenses and the dues, that is to the extent of 2 crores, if anything is left, that will be distributed to the rights and the interest of the persons. So here the right of the interest belongs to the borrower. So the balance amount will be given to the borrower. Right? Now what will be the situation? What if the borrower repay the whole amount at any time before the publication of the ads? Because for selling the asset, we have to give a publication in the ad. So what if the borrower repays the whole amount and any time before the publication ad? Or can the borrower sell the secured asset after receiving the notice of transfer of that asset by the creditor? So we'll see. Let us see. So we have answered A, B, C for the calculation part. So we have seen that first the charges, expenses have to be recovered, and after discharging the dues of the secured creditor, whatever is left, we can distribute it to the respective people who have the right and interest in that particular property. So let us have one question, practical question. Till now, whatever we have studied for enforcement of security interest. So A Limited defaulted in the payment of a term loan taken from a nationalized bank against the security created as first charge on its land and building. The bank classified the loan from A Limited as NPA. The bank issued notice pursuant to Section 13 of the Act to the company to discharge its liabilities in full within a period of 60 days. So this is the notice under Section 13(2). The company objected for full settlement and the time limit for the settlement part. The bank did not respond to the objection of the company. In light of the above provisions of the Act, decide whether the objection of the company is valid, whether the bank has to respond to the objection of the company, whether the bank has a right to enforce the security interest without intervention of the court. So we need to refer to section what we have. So the notice is correct. So as per section 13(2) and 13(3) and 13(4), 13(3), so they can make a representation of the objection. The debtor, debtor means borrower. The borrower can do that, and the creditor can reject it within 15 days giving reason. So whether the objection of the company is valid, the answer is yes. They can make a representation and objection, correct? First. Second, whether the bank has to respond, yes, they have to respond within 15 days. Third, under this case, the bank has not responded. Bank has not responded. Therefore, if the bank has not responded, will they have a right to enforce the security interest? The answer is no, because the bank has not responded, so they lose their right now. So now they cannot go and enforce the security interest. Very important, a very relevant question looking to the process flow and the time limits. Now, to the answer to that particular question, that if the borrower comes before the ad is published, what has to be done? So it is mentioned that where the amount of dues of the secured creditor is tendered to the secured creditor at any time is tendered. Tendered means deposited. Any time before the date of publication or notice for public auction, right? Then the secured assets shall not be transferred by way of lease, assignment or sale by the secured creditor. If the amount is deposited, then it will not be sold by the secured creditor. And in case any step has been taken by the secured creditor, then after that no further steps will be taken. If in case a step has been taken, let's say you have started negotiating and you have started entering into the agreement, right? No further steps would be taken by such secured creditor. That means final will not be executed. So remember, if the payment is made before the publication of Act, before the date of publication of notice for public auction, before, then will not be sold, and if step is taken, no further steps will be taken. Yes, for joint financing, friends, relevant provision, it says that joint financing, as we have discussed in the initial part, where we have multiple banking, consortium finance, then suppose one bank wants to apply, we have different measurements under section 13(4). So we can go for either the management part of the borrowers, we want to sell a particular business. So let's say we have multiple banks. And if bank one says that I want to do first part, the second says no, I want to sell that, third says no, I want to enforce, we want to give it to this ARC, then what is going to happen, friends? So in that case, in case of joint financing, multiple banking, who will prevail? Who will prevail? The one with the one who has given highest loan? No. So in that case, no creditor shall be entitled to exercise any. No creditor shall be entitled to exercise any or all of the rights conferred on him under Section 4 unless exercise of such right is agreed upon by secured creditors not less than 60%. So everybody has to come in and by vote in terms of value of the amount outstanding. So whoever decides to the extent of 60, whatever is decided to the extent of 60%, as on the record date. Now, what is the record date? Means the date agreed upon by the secured creditors representing not less than 3/4 in the value of the outstanding amount. So they will decide a record date, and the record date will be decided by not less than 3/4 in value. And that on that particular date, we will see the calculation part. And to take any act under Section 13(4), 60% should come together so that particular action could be taken. So in case of joint financing, it is very clear. So let's say, for example, a 20 crore loan has been taken against a property from Bank A, 8 crore, Bank B, 8 crore, Bank C, 4 crore. Then on default, what are the consequences? If Bank A wants to use first method under 13(4), Bank B wants to use second method under 13(4), then as per the provision, on a record date, which can be determined based on the 3/4 of the value of the amount outstanding, that record date could be finalized by that 3/4 of the people in value terms. And on that record date, based on 60% of the value, the 60% will decide the course of action to be taken under 13(4). So there are two percentages, remember. First is to determine the record date, which will be determined by secured creditors not representing less than 3/4 in value. So they will come together and decide the record date. And then on that particular record date, whatever is the amount which is outstanding, based on that outstanding date, 60% of the secured creditors should agree to a particular point. Okay. Now, then there are certain scenarios which can be clubbed with two other acts. Is with respect to when the company is being wound up as per the Companies Act. Then what could happen? Then in that case, the secured creditor who opts to realize his security instead of relinquish his security, that means he wants to sell the asset and realize that amount. When the company is being wound up. So because in case of winding up, a liquidator is appointed, and the job of the liquidator is to realize all the money and pay off the liabilities. So the secured creditor, what he can say, that either I sell off the asset and realize the money, then the liquidator will ask, please pay me that money. So the secured creditor will pay off that money, which is to the extent to be paid to the workman dues. So the secured creditor may retain the sale proceeds of his secured assets after depositing the workman's due with the liquidator. So he will pass on only that amount which is limited to the amount of workman dues. So rest amount he will keep it with itself. This is in case of winding up under the Companies Act. Now, what happens finally at the end of the day? You have given a notice under 13(2). You have taken the measurement under 13(4). Then you sell off the assets. What after that? Whatever amount you realize, still the sub balance is left. Then the option is that the secured creditor who is not fully satisfied, he may approach DRT, Debt Recovery Tribunal, for recovery of the balance amount. Then a question should come into your mind, friends. What about the guarantor, the surety? He has also given a guarantee. So in that case, the secured creditor shall be entitled to proceed against the guarantor. When? Is it after all the steps of 13(4) has been taken? No. He can proceed against the guarantors or sell the pledged assets without first taking any of the assets. So that means simultaneously they can go for the guarantor also. They would like to sell the assets of the guarantor also, because they can give a notice to the guarantor that as a guarantor, you have given a guarantee against this loan. This is the amount outstanding. So because you have that right or interest, the beneficial interest also, friends, remember, you have the beneficial interest in that particular loan also, in that particular asset also, because the guarantor has given that particular guarantee. So you have the beneficial interest in the assets of the guarantor. So friends, the balance amount which is left, you can go to the DRT, and for guarantor, you can obviously apply as per the provisions of the SARFAESI. Very important. There was a question in my example. Can the borrower sell the secured asset after receiving the notice? No borrower shall, after receipt of notice, transfer by way of sale or lease or otherwise any of the secured assets referred without prior consent of the secured creditor. Once you have received the notice, I cannot sell any of the secured assets. Remember, we cannot sell the secured assets. Friends, this is the whole part of enforcement of security interest. Enforcement of security interest. Very important, this particular section. And while doing that, while you are enforcing a security interest, you might face resistance from the borrower. So in that case, can you take the support of the district magistrate? Yes, you can do that. You can take the support of the district magistrate, and you can apply to him and give the list of assets and the related documents. And based on the request of the secured creditor, the district magistrate will go and take possession of this asset and then pass on that particular asset to the secured creditor. So that is also a possibility, because at times you might face resistance from the borrower. Yes, again, section 15 and section 16, which are very important, and we are nearly at the end of this particular topic. Under section 15, if you have to take over the management, very important, management of the borrower, then how do you do that? How do you do that? So management means you need to suspend the old directors' management. So the borrower, when the management of the business of borrower is taken by an ARC under section 9 or by a secured creditor under section 13, then by publishing a notice in newspaper, appoint a person. In case of company, to be the directors of the borrower, that means they can appoint new directors. And in case of any other case, the administrator of the business. That is a possibility. Administrator of the business. So they will take over by appointing directors. So section 15, it is only with respect to takeover of the management. Measures are 13(4). What are the steps? Under that, one part is takeover of the management. Remember, This is one part of 13.4 only. What will happen once the public notice is done? All the person holding office as directors, shall deem to vacate their office. Shall deem to be vacating their office once the public notice has been done. All old directors or any person who is in charge of that particular business, if not a company, they will deem to be having vacated their office. Somebody would come and say, sir, I've entered into contract with this director or the management before this notice came. So what should happen to those directors? Then the contract or management between the borrower and any director holding such office before the publication shall deem to be terminated. Remember, it shall deem to be terminated. And the directors, the newly appointed directors, will take such steps to take into custody or under their control all the property effects and actionable claims to which the business of the borrower or appears to be entitled, and all the property and effects of the business of the borrower shall deem to be in the custody of the directors from the date of the publication of notice. So, effect is pre-notice, all contracts will come to be terminated, and now the assets will be under the new directors. Then the powers will be given to such directors as they are the directors of the company. So all directors appointed under this law shall for all purpose be the directors of the company, and such directors or administrators shall be entitled to exercise all the powers of the director. Remember, whether such powers are derived from the MOA or from any other source. So that means now the powers of the board will lie on the new directors. So that is given under section 15. So what could be the possible question in the exams? That first is how the management will be taken over, and second is what are the impacts of publishing a notice. So the impacts are this: vacating the office, contracts terminated, custody to be given to the new directors, and the directors will now take charge of the business as the directors. Now, what can happen when the management has been taken over by the borrower? Then can the shareholders take any action? Very important. Remember, friends, section 16 comes into picture. It says that it shall not be lawful for the shareholders to nominate or appoint any person to be the director of the company. No resolution passed at any meeting shall be given effect until it's approved by the secured creditor, and no proceeding for winding up or for the appointment of receiver shall lie in any court except with the consent of the creditor. Very important. Shareholder will not pass any resolution until the secured creditor permits that particular passing of the resolution. Now what will happen? The new board has taken over, and in the meanwhile the borrower comes and pays the amount. Good. That is what the banker wanted. But then he tells, what about my business? So in that case, the secured creditor is an obligation to restore the management of the business once the whole amount is realized, and he will restore the business to the old management. But remember, we have seen one of the ways of reconstruction or solution is converting the debt into equity. So remember this point. that if the debt is converted into equity, then it will not be restored to the old management. Such secured creditors shall not be liable to restore the management of business to such borrower. Because now you are the owner. You have converted the debt into equity. You are the owner. So therefore, you are not liable to convert it into, give it back to the borrower. Sometimes this question is asked, section 16, that what about the compensation for the loss of office? So it says that no managing director or any other director or manager or any person in charge of the management of the business of the borrower shall be entitled to any compensation. That means during this particular period, they are not the directors of the company and they can ask and claim any amount. No, they cannot claim any amount. So no managing director shall be entitled to any compensation for the loss of his office or the premature termination. But let's say if a managing director or director has a loan outstanding, or he has supplied some material services, on account of his services his amount is due, then that amount could be recoverable. Other than your salary and the compensation, if you have given any loan, then you are entitled to that interest or any other thing, then that amount could be recoverable. The last part, friends, the provision of appeal, as this provision is always available in all the acts. So in same way, under the SARFAESI, there is a possibility of going to the court, that is the Debt Recovery Tribunal and the Debt Recovery Appellate Tribunal, which have been not created under the SARFAESI but under the recovery of debts due to banks and financial institutions. So under that particular act, this court has been created. So who can make an application to DRT? So the application to DRT could be made by any person, including the borrower, any person who is aggrieved. So it can be a third party also, because his security interest his interest is there in the property, the guarantor. They can also apply to the DRT. Agreed by any of the measures taken in section 13.4. So 13.4, you know, the enforcement part. May make an application within, remember friend, 45 days. Within 45 days of the steps taken by the secured creditor. Then, where do I need to apply for the DRT? Obviously, where the cause of action wholly or in part arises, where the action is done under 13.4, where the secured asset is located, or where the company is maintaining an account, where the branch is maintaining, not the company, sorry, the bank branch is maintaining an account. So, the jurisdiction of the DRT, because DRT is located at all the states, so under which state it will apply. So normally it will be based on the branch where the account is being maintained and the secured asset which is where it is located, or the cause of action wholly or in part arises. So based on that, the jurisdiction could be decided. What can the DRT conclude? The DRT can conclude that either the measures taken by the secured creditor is correct or they are not correct. So if they are not correct, so let's say they decide that the measures taken by the bank, the secured creditor, is not correct, and they require the restoration of the management or the possession of the property to the earlier borrower. That is situation 1. So under situation 1, they may order, declare the recourse to any one of the measures referred to in section taken as invalid. So they will say that it is not correct, invalid. they will restore the possession of the secured assets to the borrower and pass any such order which they may consider as appropriate. That is the order of the DRT under situation 1. Situation 2, they think that is correct. So then whatever has been done, that is correct. So they will seal it, yes, whatever has been done, that is correct. So we will not question that particular process. Now again, a situation could arise that that property which has been taken over by the secured creditor, that property is being used by a person, that is property has been given as a rent. Then the tenant can obviously come and raise an objection. So for that particular, the provision has been made that any person in an application claims any tenancy or leasehold rights upon the secured asset. Then after the DRT examines the facts and evidence produced by the parties, have jurisdiction to examine whether the lease or tenancy has expired. Is it contrary to the TOPA Act, that is Transfer of Property Act? Is it contrary in terms of mortgage, the mortgage deed which has been created by the borrower or the bank, which may have a clause that you cannot give it on rent? So if that is there in the mortgage deed, then obviously that tenancy claim would not be correct. Or it has been created after the notice of default has been served under section 13(2). So based on these, a DRT will take a call whether that particular tenant who is claiming to be living or residing or using that particular asset, whether that is correct or not. So that means the DRT could decide on the tenancy right or the leasehold rights. So what can happen if you are not happy with the DRT? But before that, I think, see, as always, the courts have a problem of, extending the cases beyond a certain limit. But here it is said that you have to dispose, the DRT has to dispose of the application within 60 days, not 16, sorry, 60 days. And the maximum time period which has been given is 4 months. It shall not exceed the 4 months. For whatever reasons the dependency is there, then it should not exceed 4 months. So within 60 days and maximum could be 4 months. What if you are not satisfied even with the order of DRT? If you are not satisfied with the order of DRT, then what we can do, we can again apply to Debt Recovery Appellate Tribunal. Debt Recovery Appellate Tribunal, where any person agreed or any order of DRT, 30 days, remember, 30 days. What was the date in DRT, friends? 45 days. Remember, DRT 45, DRAT 30 days. But remember, he has to deposit 50% of the amount due from him. So that is a challenging job, friends. That becomes a challenge for the borrower, that before going to the appellate tribunal, I need to deposit an amount that to 50%, or as determined by the tribunal, and appellate tribunal can reduce it by giving reasons, but it cannot reduce less than 25% of the debt. It cannot be less than 25% of the debt. Right, friends? So, this covers the whole aspect of appeal also and the conditions for appeal. So, the last of the provision, right to lodge a caveat, that That caveat is basically for if the borrower is, if the secured creditor is going for possession of that particular asset, then what may happen that to prevent that happening, the borrower may apply to any court and get a stay. So to prevent that particular step to be taken by the borrower, a right to lodge a caveat has been given, and the secured creditor can lodge a caveat and prevent any application which can be filed by any borrower in any of the courts, so that the process of enforcement is done in a proper manner, friends. So that is a small section of section 18C for the caveat part, and I think that covers our major of the provisions under 13 to 19. So let us solve one or two questions on the MCQ, then I'll see any questions on the received from the students, and then we'll conclude. Okay. What is the time limit for which person agreed by any measure taken by security creditor file an application to DRT, friends? What is the time limit? Can you just click, just going back to the days again, 45 days. So here 45 days. So at the time of taking over bad loans from 3 banks, it is found that these banks have filed suits in different DRTs. Securitization company wants to get these cases in one DRT, which can be permitted by Debt Recovery Appellate Tribunal. We can give the directions. Time limit within which the DRT is supposed to dispose of the application. Within 60 days, but extended to a maximum of 4 months for reasons to be recorded in writing. Right, friends? So in this way, we are coming to this end of this whole chapter of SARFAESI, where again, let me again give a reminder, 6 marks for this whole topic, quite relevant. Because as I said, maximum questions would be coming from, just trying to highlight, 13, 15, 16. Practical questions from 13, 15, 16. Then a practical question from the applicability, covering the basic definition, which you can always judge from the 5 concepts: debt, due, default, NPA, financial assistance, secured creditor. Then there could be direct question of the definition part, registration part of ARC, cancellation. So important sections are 3, then 9, 3, and 9.3 will cover the registration part, 9 will cover the measurement part, and then we have the cancellation. For ARC, for ESI, enforcement of security interest, 13, 15, 16. Remember this, ARC 3, 9 and cancellation, which are important. ESI 13, 15, 16 are important. Then appeals, 17, 18, right? And then we have the definition. Definition part. So we have, these are the broader things, and I think this could give you a snapshot of what is to be learned. So please make a note in your copy under the SARFAESI. 3 cancellation, 9 for ARC part, more important. 13, 15, 16 for the ESI part. Basic concept of applicability and definition. And then the appeal of DRT and DRAT part. So I have not received the questions. Just let me review it. Yes, only one query which I have received from Mr. Sai Kiran is requesting to upload the PPT of SARFAESI. Definitely, I'll do that, not a problem. And for rest of the people, I have not received the query, the answer to my question which I have raised. So you can always post it, and I can answer it in my next class. So friends, for today, I will conclude the whole session here, and I'll be coming back with the next session on IBC, a very important provision, very important act recently introduced, and again relevant from exam perspective, because one question is surely going to come from that topic also. Right, friends? So thank you for coming out early in the morning and attending the class today. And please raise your questions. I'll definitely try to answer it. Thank you. Jai sir.